Okay, let's start. Good morning, everyone. Thanks for joining. I guess more will join later. Always when we start, right? Probably 4 or 5 people later, more will join. But let's quickly go through what's new this week. Okay, market's red, down 2.6%. I think in the early of the week is okay. And then after the Fed announcement, everything just turned south. My portfolio also bing bang, big losses. QQQ also down. Wow, this one down even worse, down 5%. So I think the big news, right? I think actually not that many big news. I think we'll cover a couple of the news in today's session. I think the key one will be Fed announcement, and this one I think is no surprise also, because I think before the meeting, everyone know that it will be a 75 basis point increase in the Fed fund rate, and then that was announced. I'll just quickly summarize what is new, at least to me, when I listening to Jerome Powell's speech. I think the 75 basis point, I think this is expected. And even after the announcement, right, if you look at the implied rate, which is shown here, the implied rate also is about the same, meaning that when it comes to next meeting, right, which is mid of December, there's still about 50% chance of whether we get a 50 basis point up or 75 basis point up. I think this is still 50-50. Not much has changed. But what is different is that during the conference, press conference, I think, he mentioned that this one, the speed is something that is already played out, right? Now they have successfully increased 75 basis point for a couple of times. But the more uncertain part is how high it will go. Because if you observe, right, actually from, can you please mute, who hasn't mute the call? How do I mute? Okay, so if you observe the Fed fund rates, the projections, right, I think around next year, it's expected to, let's say, peak at 500 basis point and then just stay there for some time, right? But during the conference, he mentioned that we actually don't know. Like, there's some uncertainty. This 500 basis point level, it could be higher if the inflation still stay high and didn't cool down. So this is the first uncertainty. The other one is that once they increase to a level, let's say above 500 basis point, right? Or I think even at this point, it might not stay constant. It might still continue to go up 25 basis point every meetings, and then we still don't know like how long they're going to hold at this level, because imagine that at 5% rate, right, it's actually very, what we call it, the contractionary monetary policy, meaning that money will be tight. So if this level stay for very long, right, it will be very painful for whoever that is borrowing money or whoever need to fund their operations with it using cost of debt, right? Because cost of debt will be much higher, and even for the government, it's also a kind of problem also, because government also need to raise money, they need to fund their budgets, right? So if this one drag on for a very long time, I think it will be very bad for the stock market. But I think for now, there's still, if you look at this, there's still some hope that by the end of 2023, the rate, because let's say inflation has cooled down, right, the rate should expected to drop down. But again, there's a lot of uncertainty, because now we really don't know like inflation, how soon, or how soon it will cool down, and like when the timing part is very hard to say. Then on the Fed fund rate, if you observe after the hike, right, now the Fed fund rate is already higher than 2018 monetary tightening. I think this one I mentioned a couple of times before. I said, like rate hike, this is not something new, right? It happened in the past, and now it's just another episode of monetary tightening. It's just that now it is already higher than 2018. So I think the last time it increased so much was that prior to 2008. This level is about 5.25%. So I think if we get another couple of rate hikes, then we are looking at the rate similar to 2008 or 2007 level. Okay. Let me mute. I forgot to set everyone to mute. Okay. Then. Okay, what's the implications, right, to the stock market? As you can see here, this is the chart showing the forward PE. So I think 1 year ago is already pricing at 20x PE forward PE, meaning that the earnings is based on the forward earnings, the projected earnings of next year. So if you can see that now the earnings, look at the blue line. The blue line is slightly dropped. Right? This is saying that now the forward earning actually trended down slightly. So prior to that, you see it's just going up and up because the market looks good, right? Now we can see that there's some, like signs of recession is coming, and then hence the earnings, the forward earnings had already lower. But what has changed the most is not the earnings, because this one only dropped slightly, right? But the red line is the forward PE, meaning the multiple that we paid for. So just 1 year ago, basically when the market is good, you need to pay a 20x forward PE to buy the markets. So actually more than 20x, you see this is slightly higher than the 20x line, right? Now at 16 times is a lot cheaper compared to 20x, right? Yeah. So market indeed has already cooled down a bit. But if you want to say this is very cheap, I would say not so, because you see, in the past, it could actually, let's say during European sovereign crisis, right? It could be as low as, let's say, between 10 to 12x. And even during 2018, you see it touches this line, which is about 14x, right? Currently, we are at 16x. So it's still like not so cheap. Like it's much cheaper compared to a year ago. But if you look at longer history, it is around fair value, I would say, if we take the forward PE as a metric. Then I'll just share a couple more, which I found it quite interesting, because this website, right, later I can share in the group now. So this website, right, is showing 6 matrices that tell us whether the market is expensive or not. I think I shared before, but since the last time I shared, right, I think the market already is at different level. But the interesting part is that now out of 6 metrics, there are 3 actually saying that the market is fairly valued. Then there's 2 that is telling us that the market is overvalued, and there's 1 that tells us that the market is undervalued. So all in all, you average out is slightly on the overvalued side, but quite close to fairly valued already, I would say. So the first one that tells us that the market is overvalued, right, is what I just shown, right, which is the PE. As you can see, the CAPE, right, this is the cyclical adjusted PE ratio. If you look at it, it's like still above historical average. So like similar picture, right? If you look at this is just looking at the forward PE, is still above the average. If you look at this is looking at the earnings, is the 10-year historical earnings adjusted for the inflation. So the E itself is slightly different, but the conclusion is about the same, meaning that the market valuation is between fair and expensive. So you see the yellow line here. So this is telling us that the market is still overvalued, but I think if we continue to drop by another 10%, then it's like under the fairly valued territory. The second one, which is, I think this one also not new, actually quite a number of people is pointing this out for some time already, which is the yield curve, the shape of the yield curve, meaning that I think there's quite a number of measures. Some people, they will compare 10-year versus 3 month. Some will compare 30-year versus 2 years. I think these are the common, the benchmark. But if you look at this 10-year versus 3 months, I think you get the similar picture. If you look at 30-year minus 2 year, we are looking at the yield curve, which is already inverted, meaning that if you invested in short-dated government bond yields, you actually yield higher returns compared to those that is longer. I think this one, why it is showing overvalue is because usually when the yield curve inverted, right, and this one is a good how to say, a sign, like give us some sign that it's a bearish sign whenever it is inverted. So now because it is like heavily inverted, if you look at the 30-year versus 2-year, it's even worse, right? The situation. The 30-year is still very low, and the 2 years is already spiked out to around 4.5%. So this yield curve inversions, usually after that market will crash. So that's why this is an indicator to tell us that, okay, even if you look at the stock that you like, even it dropped a lot, right? Because of the macro situation, you might want to keep some cash buffer to buy it at a more attractive level, maybe, like 3 months, 6 months down the road. So this is another indicators that tell us, hold on, don't put all your money into stock market first. Okay, then the good news, right? Good news, which is what's pointing towards the market is undervalued now, which is the margin debt. This one also quite interesting because this is not looking at the prices, right? This one is looking at how much margin, like in aggregate, how much margin that people took on in terms of into their portfolio. So like let's say if I take a margin, it's recorded somewhere, right? So people know like how much borrowings all this investor has taken. So if you take an aggregate and then take the aggregate margin as an indicator whether it will predict the market direction, right? It's always that when many people, they just load up their debt, they take on margin when the margin level is very high, right? Meaning that people over leverage. Whenever there's some downturn and then people have to, cut loss or force by the brokerage to cut your losses, meaning that you have to sell, right? So it will actually make the stock market performance very bad later. But if you look at it in the opposite way, currently the margin amount is actually quite low, meaning that whoever they are holding stocks, right? Most likely they are holding stocks with their cash rather than margin. Meaning that if you want to hope for people selling their force sell their portfolio, right, is a lot. How to say a lot? It is much harder as compared to 1 year ago where the leverage ratio is quite high. So I think this is good sign, meaning that there's a lot less all this hype in the market. And this is always a good time to accumulate the stocks, right? Yeah, I think these are some of the things that I found quite interesting, and I just want to take this opportunity to share with you all. I think just to wrap up, right? I think when we talk about macro things, some will say this is useless. It is, and sometimes this is just because there are a mix of data points and you can always point to something and say, yeah, market is good, you should buy now. Or you can point to the other things and say, hey, actually market is still expensive. So there's always mix of information, and I don't think any one of this is like 100% predictive power. It's just that these are some of the data points that can help us to make sense of the market situation. And I think have some awareness of what's going on with the market is always helpful, right? So that's my sharing for this week. Okay, let's move on to the Q&A session. Before we start with the Q&A, anyone have any questions or any topic that you want to chat up, and I'll just pause a second to make this session more interactive. You can just voice any question that you have before we go to the Q&A session. No? Okay. Let's go through the Q&A. The first one, rumors that China is opening up next March, market recovery hopes gone. Okay, this one, I think the questions were posted earlier, so I got the chance to look at a couple of, take a couple of screenshots just to help the understandings, because I believe some of you listening might not aware of this news, right? So basically, I think just actually a couple of days ago, I think it's 1st of November, if I remember correctly, there's this rumor spreading up. First saw it from the Twitter. I think people should also share on the Telegram group. There's this news about China. There's some they already formed a committee to basically discuss about the reopening of China, meaning that they are going to move away from the COVID-0 policy. So basically, this is the rumors. I think it mainly came from these two how to say, these two user or Twitter account. So the first one from, I don't know how to read actually, How Hong, heard that reopening committee has been formed and led by Wang Huning, Politburo standing member. The committee is reviewing COVID data from US, HK, SG to assess various reopening scenarios. Target March 2023 reopen. And then I think the other one, which is this coming from Shanghai Macro Strategies, it's rumored that Beijing will soon establish an expert team to put together a conditional reopening plan. The goal is to materially reopen the country by March next year. The upcoming 10 editions of COVID guideline is widely expected to provide upside surprises. Okay, this is from the Twitter account, and then from the Bloomberg articles. I think this is quite interesting because this round, right, usually is Bloomberg is the one that come up with news, unverified news, and people say, okay, these are all fake news. And this round is coming from the Twitter accounts, and then Bloomberg actually say that these are unverified online posts about China reopening help key stock gauges post their best weekly performance in years and spurred gains in the yuan. So what's going on now, right? I think just to summarize is that there are rumors of reopening. There are experts in China that talk about like China is going to reopen. And the reopening, we are not talking about now or end of this year, right? They're talking about like March. And then there's some news that's related to some vaccines rollout and so on, right? What's my take? Actually, my take is that I'm quite skeptical on this kind of news. It's not like I don't believe that there will be reopening. I don't have a view. It's just that when all this is spreaded in on Twitter, like accounts like this, right? It could be true, but it could also be something that is just some fake news, right? We don't know how to verify it, and I think the one that we should trust 100% is the official channel. And the official channel, I think, at least from China, is still saying that they still adhere to the COVID-0 policy, right? So I'll take that as like official news. And before that happened, right, I will be very skeptical on all these, all this news. Like, especially when you look at the markets, right? You see, I think this is a very interesting chart. You see that the spike in the weekly returns, right, of Hang Seng China Enterprises Index, right? And you look at this Hang Seng Index weekly performance, the spike is really, really quite significant. As in, if it spiked already because of this news, and then you just want to play with the market timing and you just enter now, right? Then suddenly, actually, this one just like, all this spike could be some, short covering and so on, right? And if this news cool down and then there's no news, it's not like anyone denying this news, right? It's just that, okay, no updates, then market will probably just come down and you basically just trap into this trade now. I think this happened quite many times in the I think in the past. So I would say that probably even if you really bullish on China, you might want to wait a bit more for it to cool down. Then only you buy in some tranches, right? That's for long-term investing, right? If you want to do some trading on this, just be aware that, this kind of news, it come out, market spike. And then, likely is that, after it cool down, the market will just readjust. Those who covered their shorts, right? They may come in and then short the market and then come back again. So I think this one, I'm not that hopeful. I will just say I'm observing. I don't want to say this is impossible. Anything is possible, right? It's just that whether you think in terms of risk reward, does it make sense to bet on this kind of rumor or not? So my take is no. But with that said, I have some Chinese exposure. It has come down quite a fair bit after the market drop, right? So all the correction. So the percentage is very small now. I'll just keep those. I have no plan to add or to sell them, right? So I'll just keep. So all this news to me is just entertainment for me now, which is interesting entertainment sometimes. What's up here? See, anyone want to share what's your thought on this news? Whether you believe truly they are reopening, or actually you're also skeptical, or you don't believe, or you say this is fake news. No view, then we continue. Will we get a strong year-end rally as per usual for midterm election years? Okay, anyone want to share your thoughts on this? I actually don't have much view on this. I think people like to say, okay, whenever there's midterm elections, presidential election, or even let's say Malaysia now elections or Singapore elections, right? I think there's this understanding that usually before election, there will be more good news, and then market will be good. And then it's after the election, then reality set in, market will drop later, right? I think this one, I don't think this is new to you all. I also heard of such, argument in the past. But usually, I think in terms of the correlation, I am a bit skeptical. I do believe that there will be some policy that will be rolled out beforehand just to help out, right? Which already been rolled out because this election, I think it will be coming in a couple of days, right? So the problem is not about the policy or the market sentiment. The problem is always that even if this one, all the policy have some positive impact, but there's always stuff that is on the background. For example, like inflation. In the past, let's say, whenever we have elections, the inflation is like, let's say 3%, right? But now it's like how much? 8%, 9%. So there's always like different environment at the background that will have impact to the stock market as well. Hence, this kind of things is too noisy. Like we really can't tell. Like, okay, is all this election effect higher or lower than the effect coming from other factors? For example, like inflation or monetary tightening, all these things, right? So it's a mix of things, and it makes us very hard to differentiate the factors and then do a quantitative study and have some form of like some academic kind of conclusion to say yes or no. It's a lot harder, right? So because of the noise, that's why I'll usually take this as like, okay, I don't pay much attention. So yeah, that's my take now. Anyone else want to share? If not, we move on.
Hey, hi, Boon Tee.
Hi.
Can you hear me?
Yes.
Okay. I'm outside. I hope you all can hear me. I actually did a bit of reading on that and found some interesting fact. So I know a lot of our investors are speculating that, hey, elections are coming, and then by right, the Fed or US government, they wouldn't want the stock market to reach like all-time low. But one interesting fact is actually based on stats, right? Historical trend. Usually after the midterm elections, especially when they are in November and December period, usually it's followed by a rally. During the 1 or 2 months. And another interesting fact is the year after that midterm elections, usually there is also another rally. So the returns generally it's quite good. I think the stats is based on the last, 60, 70 years since post-World War II. I think viewers, if you are interested, you can Google it up. So that's one. But then I think, as they always say, historical performance shouldn't be an indicator of the future performance. So I think now we are in a very different situation, with all the high inflation, high interest rate high, slowing economy. So I think it's a bit of a historical stats versus the current weak market. If you are expecting a rally, it's also a bit like fighting the Fed. So there's something for investors to think about, whether you want to follow the historical trend or whether you want to fight the Fed. Yeah, just my thoughts.
Thanks for the comment. I think on the first one, right, I will say usually if you compile the historical data and then you just do a comparison, right, you say, okay, there's years with election, there's year without election, and then you can track like 1 year after the elections. You can do some comparison of these periods and try to conclude whether election have some impact or not, right? I would say don't pay too much attention to the average. Usually when they compile this, they will try to say you average the year with election and you average the years without election, and you just minus, right? And you try to say which one higher, which one lower. The problem is not with the difference, because even if I just say, there's month where earning release come out and there's month that earning release didn't come out, I also can do some average and just compare. There will always be different, right? But that different could be just noise, and it could be because really of all these elections, right? We don't know like whether it is because of election or not. That's one thing. Secondly, I would say, aside from the average, meaning that you take the mean and you deduct, you need to pay attention to the variance, meaning the noise, right? The volatility. Say for example, let's say in the 60s, so you minus out, and then you have some delta, and then in the 70s, because let's say every decade there should be some elections, right? You repeat this for every decades, right? And then you look at the variation. Sometimes, yes, on the average, there's some difference. The difference could be, I don't know how many percents, right? But if you look at the variation, it could be like very noisy. Like, okay, actually, actually you thought that there's got election, no election, it will be like on average higher by 1%, right? But actually when you look at the difference, it could be like, okay, actually election years is always down by 1%, 2%, 3%, 4%. But there's one year that there's one data point that shows 10%, right? And then you need to figure out why that year is so specific, have that 10% difference, right? It could be that 10% is because, right before the election and right after the election, something significant happened and it distort the entire data, right? So that's why I would say, because of all this, there's a lot of noise there, right? And when it comes to statistics, there's always a way for people to, try to present it in a way to give you an impression that, yes, this is due to the elections. And it's easier to lead you to believe that you have to look at the data to actually, get some, to be convinced actually to be convinced that this is indeed true. So I'm very skeptical because I've seen this very often in the past where people just, cherry pick and then take the cherry pick data and try to conclude something. That's true for many other topics. But for the election, I guess because this is like everyone talking about this, right? I believe there are some truth in that. It's like, okay, there could be some policy that government tend to roll out when they are in power and in hope for like better mood, and then they can re-elect again, right? This one, I think definitely there's some structural advantage. Not to say that there are none, but just that when it comes to statistics, we all need to be careful. Yeah. Okay. Okay, next question. Thanks, Jay, for the comment. Not that I try to debate you, it's just that I just comment based on your comment. Okay, next question. If you reset your portfolio to cash, how would you allocate money now? Bank deposit, T-bills, SSP, savings, equities, bonds, commodities, crypto. So I think this is talking about asset class allocations that you can. Anyone want to share, or Jay, you want to share what's your take now since you are here? Okay.
Yeah, maybe I just share. Hi, morning all.
Hi, good morning.
Yeah, okay. So this question, T-bills, SSB, savings, blah blah. Okay, and because I'm a REIT investor so recently REITs got crushed because of the rising interest rates. If you ask me, I wouldn't say that T-bills are really something that I would look at over REITs, because the T-bills is kind of a short-term thing, like the 6 month to 1 year thing. So let's say I buy a 6 month T-bill, which looks very attractive now, but then what if the Fed pivots, during the 6 months? Then the REITs start to rise, and then by the time I get my money back from the T-bills, then I have to buy the REITs back at a higher price. But I think what will really send REITs to hell is the SSB. Yeah, I think if the SSB, which is currently around 3+%, not say that high yet, but I think if the SSB rate goes up, then I may forget about my going into REITs. Now I'm looking to go into REITs, but if the SSB goes really high, maybe 6%, then I would forget about REITs, and maybe just put my money in the SSB, get 6% over the long term. I think that'd be quite hard to beat. That's all.
Thanks, for the comment. I do agree with you about the SSB, because whenever we talk about T-bills, right, I think T-bills, let's say 6 months or 1 year, we don't know what's the rate next year, right? So for example, you can lock in, let's say 4.5% now. 1 year later, it could be like left with 3%, right? So there's uncertainty of how much yield that you can get. But let's say if SSB, which allow you to lock for 10 years, right? If it goes up to, let's say 4.5%, I think currently it's about 3.5, right? So if you go up for another 1%, I think it's really become a very strong competitor to the REITs.
Yes.
Yeah. So that actually quite, how to say, for REITs price may adjust down because of that. And I do think that the 10-year, because of the mean reversions, right? Not mean reversion, the yield curve inversions, right? Actually, I think the 10-year bonds could actually still continue to rise. It's still quite low. Let's say if you look at 3.5, given that, Fed fund rate, once it reach, like, let's say 4.5% or 5%, right? I don't think Singapore 10-year can hold at 3.5% level. The spread is too wide for these two economies, which is still considered quite interlinked. Because Singapore is still like very small economy, right? Tag to US and influenced by US a lot now.
But that being said, I think T-bills are very good for like for investing monies that you can't touch, that you'll need in the short term. Like, for example, if you're a student, and then your parents gives you your tuition fees in advance, maybe you can put it in T-bills, make some pocket money, Yeah, that's what I would do. I would use T-bills for that purpose.
Just need to careful with the, let's say if you need to liquidate your T-bills, there's some bid-ask spread there, and then just be careful on that. Don't sometimes the bid-ask spread, I heard it could be quite big, right? So need to be careful. So I heard that, for T-bills, you need to plan, assuming that this T-bill you are going to hold to maturity. So let's say you buy a 6 months.
Correct.
I think there are other accounts, for example, those multiplier or 360 that can give you, I think it's lower than T-bills, but those are truly liquid, right? So I think those are better for let's say, month-to-month kind of cash flow management. Need to have balance. So those extra one T-bills, to me, I think it's quite attractive. Let's say if you can get, let's say 4.4% or 4.5%, right? If you can reach that level, I think quite attractive. So I think for me, right, when it comes to allocations, I haven't really changed my portfolio significantly in the past, let's say 3-6 months. It has been quite stable, but because my portfolio is already like dominantly into equities already, so I do see that T-bills reaching at above 4% is quite attractive. And like in the beginning I talk about like the macro situations also is not doesn't point to bullish, right? Let's say market could drop, always. This should always be the assumptions, right? So sometimes put some money into T-bills and get some liquidity, and just to, smooth out our portfolio values, right? It's not like, let's say if the market's tanked for 50%, your net worth, you don't want to tank by 50%, right? You might want to have some money into like T-bills or SSP just to help to cushion the hit. And then always, once that mature, you can take the money and then invest into stocks that you like at a cheaper price, right? I think this is always something that can help you manage your emotion. I think there's some value in it, given that, for people who have, let's say you already have 90% into T-bills, you might not want to continue just put on T-bill, given that stock tend to outperform over the long term, right? I think you should balance between different asset classes. But for me, I'll just stick with my current plan, which is that I allocate some money into T-bills, some small amount, but mostly I'm still my money is still with equity portfolio. Okay, let's move on. Which research website do you professional investor use to research stocks for scanning financial, etc.? Do you read 10K, 10Q transcript? Wow. Mr. Ng, quite a number of questions from you. you want to unmute and ask, let's say, just to give us some of your, how to say, like commentary, or can you speak? Okay, so then I read out the questions for you. Okay, I think the first one, right? What website, right? I think in terms of website, I think quite a number of them has been shared in the group already. So I would say that 10K, 10Q, meaning you look at the numbers and also some of the commentary into the 10K and 10Q, right? And transcript, right? I think these are the most official one. Like if there's anything important, right? Say for example, take Amazon. The cash flow is negative, and then like the earnings number looks bad. There must be something wrong about the companies that you see big losses, right? And usually this you definitely can find in 10K and 10Q. You can just read 10K and 10Q, assuming that you don't know anything, you just read through. which will be harder because you don't know where to pay attention to. But if you read the transcript first, you will see what kind of questions the analyst asks, right? Then you know where to look at things. For example, they might say, okay, you have this overcapacity issue. What's your plan? Then the management will try to answer like, oh, what they have been doing and what's their expectation for the near future. And then just to make sense of the magnitude, you can just look at the 10K, 10Q and look at the amounts, right? So that you have a better idea, like what are the magnitude that we are talking about. Like say, for example, Meta also, we talk about the reality labs, the expenses will be increasing in the future, right? You want to know what's the expenses or the burn that they're doing for this quarter. All those numbers, they are all in 10K, 10Q. Actually, with all these three alone, right, you are good to go already. You don't really need to read news already because the news quality, right, is definitely lower than these three one if you are able to consume. The problem is these three things are a bit dry. So let's say if you don't know what to focus on and you just read plainly, right, you will fall asleep by reading all this. So that's the challenge. And reading news articles either from Reuters, CNBC, I think those are slightly better because they simplify it. And then once you simplify it, it's easier to consume, especially if that companies that you are reading, right, you actually still starting and you don't know a lot about the company. Then I think reading news is some like the easier way to absorb the content. I think I would say other sources, right, is mainly just to ease us to visualize things. For example, the macro trends, right? If you key in the companies, it will show the past net income in chart forms, right, in bar charts, right? So it's easier to visualize. There's another one called Ticker, TIKR. I think that one also quite useful because you have the numbers and then you can read the transcript from that website as well. I think these are the two that I rely on quite frequently. Other than this, right, I would say actually the best one is Google. You just Google it, right? And then whenever Google lead you to any other sources, then you just read. I think Seeking Alpha could be one, but Seeking Alpha sometimes, because of the paywall, sometimes you can't read the details, right? So I think that one also is you need to have a way, either you pay for it or you find a way to bypass it. I think these are the common one. And these are definitely enough. There's a lot in a couple of sources that we talk about. But for me personally, right, for companies that I just like browse through, I will just read the news. To me, it's good enough. But when I want to do a deep dive, right, I definitely will go to their 10K and 10Q. I think you will see a lot more details that usually in the news they won't cover all these details one. For example, if you look at my past videos when I compare let's say Amazon versus Tesla, right, you see all those charts, right? If you read news article, those charts won't come out one because they have their own narrative to paint, right? They will look for their own chart. But for us, we have something specific that we want to see ourselves, right? And the stuff that I'm looking at might not be the stuff that you want to see, right? And if you look at 10Q, then you can look specifically for the items that you want to see. So that will fit to your purpose, right? So I think these are the best one. So yeah, this on these questions. Anyone else want to chip in on these questions? Or any good sources that you want to recommend? Okay, next one. Is there any Hong Kong stocks to look at? Already had BABA and Tencent, looking at other sector with good margin and growth.
For me, I am looking at ICBC lah. Disclaimer: I have ICBC shares lah. So yeah, so I'm looking at ICBC. I don't know about the growth part. Yeah, I don't know, whether ICBC is going to go to the moon or what. But what I do know is that, based on the last report, the PE is pretty low. Okay, and let's say, because of the China lockdown, the property crisis, blah blah blah. Okay, even if I reduce the EPS by 40%. I think the PE is still like around 6 only, So, okay, maybe it's a very boring business, okay? But if you think about it, I don't think ICBC is going to collapse or anything. So you just imagine you just buy the stock at a PE of, let's say, 6, and you just sit on it. And, they give a decent dividend. Yeah. So, yeah, you just sleep on it and yeah, I think you in the long term, yeah, I think you're all right. I don't think it'll collapse. Yeah, it's the biggest bank by assets in the world. Yeah, maybe it's just boring lah. That's it. And now I think the lockdowns, this and that, the stock price has fallen significantly. So I would think if you're gonna buy something, might as well just do it now. If you're gonna buy a Hong Kong stock or a China stock, yeah, you might as well just do it now. Especially if you're sitting on a lot of cash. Yeah. Personally, if I had more cash, I'll buy more lah. Yeah.
I have a question. Do you know ICBC, what's their exposure to the property sector? Are they like heavily
no, okay. This
affected?
I do not know. I guess they would be impacted lah. To some extent. To what extent, I do not know. Yeah. But as I mentioned earlier, right? Let's say I slash their earnings by 40%. Yeah. From 1 to 0.6. Okay, I think the stock now, the price now is 3.5. Yeah, so let's say I slash their EPS from 1 to 0.6, 40%. Yeah, you have a P of around 6.
Got it. So just want to check, let's say if we look at DBS, right, I think we discussed in the past, basically they have their lending business, mortgage business, and then also they have some, like asset management, and then some, some high margin kind of businesses, right?
Yeah.
I just want to know, like roughly when we talk about the breakdown of the business, does ICBC also have this kind of like high margin business? What was the, like the allocations into different lines? Are they mainly onto like lending, mortgage, or do they also have like similar all this advisory or whatever so-called the high margin business? How's the breakdown?
Yeah, that's a good question. Unfortunately, I didn't really delve that deep lah. I should lah, but I didn't really delve that deep. Yeah.
I think maybe you can do some preparation, and then next time when we have this call, right, I let you do a presentation, make a case for ICBC. I think that will be quite interesting.
Yeah, I'm a bit lazy, so sorry. Yeah, I should. Actually, I should. Yeah, especially as an investor. Yeah. Oh, and by the way, DBS, right? I think I saw their slides. I think their wealth management earnings took a big hit. Yeah. But when I read the slides, the management seemed very upbeat about it. So, I don't count on it, but yeah, but I just want to say that they sounded very upbeat about their wealth management sector. Yeah, that's all.
Okay, got it. Thanks a lot. Okay, next question. So we will just go according to this sequence. Someone just upvote. What is your thoughts on NIO? I like NIO compared to Tesla because of NIO valuations. It reversed on Friday, and have we seen the bottom? I think this one, okay, the questions come last minute. If it comes slightly earlier, I can pull out some slides, but just for your information, maybe I can share it in the group later. So for NIO, right, I think there are a few things. Number one is that the COVID situations is really bad and hit their productions. So I think they just announced close of their plant, their factory, because of the COVID. So it might affect their production, their delivery. So their numbers will look quite ugly. And before they close down, right, their numbers aren't that good in terms of their financial numbers. They are not profitable yet. They're still scaling up. Now the scale up has problem because of the COVID. So I would say if you have investment into NIO, please be careful. Don't just act based on the share price alone. It's not like share price drop, then you buy, it will surely bound. Because if the COVID situations worsen, right, and if they burn out of cash, they need to raise capital or do something like this, it could be heavily, it could incur a heavy dilution, and those could be like permanent kind of loss. So harder to recover. So that's on NIO. And then I have also looked at the charts of NIO production delivery numbers compared to XPeng. What's the other one? The Li Auto, right? I think these three automakers, the EV automakers of China, they're not doing that great this year. their growth rate actually is quite low. But what is doing great is BYD. If you look at BYD numbers, right, I think this year their growth rate is very high. And then recently they just announced the earnings. I think their numbers also very good. I haven't looked into the details, but just on the surface, right, I think that they are doing very well. So I would say that, let's say if you're bullish on Chinese EV, right, I would say currently in terms of the performance, right, I would say BYD is much better than compared to the other three. Yeah, so that's a very surface commentary because I mean I don't have investment into all these companies. I haven't followed that closely, just some surface data that I've seen just this week. Anyone want to share on this, or anyone following Neo want to share your thesis, your commentary? Okay, next one. Is there any? Hold on, this one done. Okay, next one. Other than IB, what other brokers do you guys recommend? Also for Hong Kong market, seems like there is no live feeds on broker platform. Have to pay for them. For stock price monitoring, I've been using Rumour. Rumour for US stock, confirm I can get the live prices. I believe for China also live prices. I'm not 100% sure. But if you access to the desktop or website, right, I think there's one called the ET News or something like that. That there's a live prices. Please, if I forgot to share in onto the chat group, please let me know. I'll share that. So I think that one for sure is live prices. So you don't have to subscribe, don't have to pay anything. I think there are sources that provide these live prices. In terms of brokerage, I would say depends on your use. For IB, right, I think this is the most, how to say, well-balanced, very cheap. And then if you consider, like they don't actually do all this payment for flow kind of things, right? So in terms of execution, I would say IB also like much better than the others. So I think IB is the one to go. But if you really compare the prices, I believe TD Ameritrade, especially for those who do, like options trading, right? I think TD Ameritrade is also very cheap. I think it's cheaper than IB. So that these two are the one that you can consider either IB or TD Ameritrade. But please pay attention because sometimes they are cheaper in terms of the options pricing, but when it comes to margin, then suddenly you need to pay a lot more higher margin rate, right? So it's not like there's one brokerage that win all areas one. So depending on your use case, I think usually these are the two that people look at now. For me personally, I'm using IB. Okay. Next one. I started using IB and signed up for the share lending program in the hope of earning interest. Seems like no one borrowed my stock. Any advice on share lending? Yeah, this one I also have. I think whether people lend your shares, people borrow your stock or not depends on what stock it is. So sometimes, it is like stock specific. At the same time, also depends on on the platforms. It's not you one person that is lending out stocks, right? There are other people who also allow for these share lendings, right? So I would say that I don't have any tips, but it is stock specific. So sometimes it's not because of your account. Sometimes it's because of the stocks that you own. So please pay attention to that now. And for my past experience, I don't think this is that attractive. It's just that some very, very small kind of earnings that I can get. So it's free money anyway. So I'll just leave it there. But I don't have tips. Maybe some other people have that you can maybe check with others. Maybe you can post this in the group also. I think maybe some other people are more active in this and know how to game this, right? I don't know. Anyone want to share on this? If not, we move on. Does anyone remember during previous bear market, did Buffett come out and recommend to buy stocks? I'm monitoring. Seems like he is very quiet. Is it abnormal? There are a couple of quite significant event that he indeed came out and say this is time to buy stock. But definitely not the recent past. I remember even during COVID crisis, he's very, very quiet. And even during the annual shareholder meetings, he sound a bit bearish. That's my take. And that was also the time where he sold the airlines. And then there's a lot of commentary back then. I don't remember all of them, but you can just watch the shareholder meetings. But in the past, right, say for example, like during 2008, I remember he has written articles posted on, I don't know, Forbes or like, some mainstream newspapers, and just to say that, okay, now is the time to buy. So he did that before. I mean, it's not just 2008, right? I think even prior to that, he did a couple of times. And then during episode like .com bubble, also he also came out and say that, and hinted that this is not a good time to too bullish on the markets because of the market is too overvalued, right? So he only come up when the stock market is either very, very bullish or very, very bearish. So I would say if you just look at what I just presented earlier, right? Actually, the sense is that the current market valuation is not super high and not super low. Usually this kind of period is, he's not that vocal. So that's his style. But you can always look at whether he's buying or selling, right? So I noticed that in the past, let's say 1 year, he increased quite a fair bit of exposure into energy stock. For example, like Chevron, Occidental. So Apple also he's still buying. So Apple definitely is he buying, not his lieutenants. So and Occidental Petroleum, I think also the same. So these are his pick now. So you can pay attention to those. I think the source is the Data Roma website, right? I think that one is quite good. Usually the 13F filing, it will come up 45 days after the closing, meaning we will get something in 2 weeks' time. You will see like those, like so-called the famous investor, they will have to do their 13F filing, and we can see whatever they bought or sold during the Q3. There's 45 days left. Sorry, I lost my voice already. Need to cut it short already. Anyone want to comment on Buffett? Okay. Market is on Hopium for Fed pivot. I think it's still too early, at least not until Q4 2023. Am I wrong? Yeah, I think this one I do agree. I think it's still a bit early. But the thing is, these things, right? This pivot thing, right? It could be true that it's too early, but when it comes suddenly. It won't come gradually. So that's the things. But I also think that it's still early because no sign of inflation cool down, right? So probably you need to wait a couple more months, let's say by early next year, and then look at the inflation data at that point. And then Fed official also say that it's not like one data point showing inflation drop, then they will pivot. So that's not the case. They will actually need a lot of data to convince them that now inflation has cooled down, then only they will lowering down the interest rate. So that's official Fed officials takes, right? But for market, their reaction is always like, always overreact, right? So let's say I think inflation data will come up soon, right? Let's say inflation data just much lower than the expected numbers, right? Market will for sure, it will rally. But don't expect that the Fed will suddenly come up and say, hey, actually, we are fine already. We will just pause here. And then let's stay at current level. That's not going to happen. And they communicated this for quite a number of times already. So I do trust them at least for the 6-month outlook. Longer than 6 months, nobody knows. Okay. Anyone want to comment on this? Like what's your opinion? Do you think that like the pivot will come soon or not going to come soon? In a bear market like now, do you professionals gear up margin to buy stocks at low price? I look at this question, do you professional? Okay, I'm not professional. This is just retail investor talking with retail investor. Don't call me professionals. But I do pay attention to what professionals are doing. And this so-called professional, I think this one is like too big of a group to describe. They are not like one person or one same type of person doing the same thing. Some people will call it, institution. Now institution buying, now institution selling. I'll just say that institution, this group, right, is so big, like you can almost say that, okay, retail. Are retail buying? Are retail selling? Are you as a retail and me as a retail, are we doing the same thing? I mean, these are like like a big group that you have all sorts of different players instead doing all sorts of different things. At the same time, there are people who's buying, same time there are people who are selling. So it's a very mixed bag of group, because this grouping is too big already. So let's say if you want to be more specific, then at least really need to like look at the subset. If you describe like, okay, other hedge funds, what are they doing? These things, I think still okay, because they are, like more similar to each other. But if you do a professional, like a big grouping, sometimes I think it's too broad to comment. So that's one thing that I want to point out. Then on to your questions, right? Margin or not, I think these questions also depends on institution. For institutions or so-called professional, you need to see like what business are they in. Say, for example, like this business is managing someone's pension, for example, right? So they will have all this like mandate to say, okay, when the portfolio managers, they manage the portfolio, what kind of things that they can do and what kind of things that they cannot do. So even this margin, can they margin up or not, is already something that is very key decisions. Because if you say you have no margin at all, let's say a mandate says zero margin, right? You cannot take up loan, right? It is like impossible for the stock to go to, for the fund to go to zero. But let's say even if with a 20% margin, right, technically it can go to zero, right? So I think the difference between a mandate that is with margin or without margin is very different. So that's why the first thing that you want to pay attention to is which group of professional managers you are referring to. Some actually they can't, even they want. So you need to differentiate that first. Then secondly, who are the groups of investors that actually, if they want to do margin, they can do that, right? Usually these are, what we call like a discretionary kind of fund managers, more like hedge funds. Hedge funds, usually they don't have many rules, one. They can do whatever they like, one. So that's hedge fund managers, right? Other than hedge fund managers, I would say majority of the fund managers, they can't do leverage freely. If it can be done, right, it will be a limit. So usually they are, for professional, this is like describing the big group, right? Usually there are a lot of guidelines, a lot of restriction on what they can and cannot do because of like the mandates that I just described. Like this is like a very basic things. Even if let's say you are high net worth, right, and you talk to your advisor, right, they will discuss with you and come up with like a investor policy statement and say, okay, my relationship with you, I'm your advisor, what I can do, what I cannot do, and then how are we going to approach this? Like you have asset allocations. So those kind of things, right, it will be in the form of a document that detail like, okay, this is the structure and these are the guidelines and these are the restrictions. So once they are bounded by the guidelines, right, they basically a lot of things they cannot do already. So that's why when you hear like investor who like put in money into like, wow, I leverage out and then do crazy things, right? You just look at the pattern, you know that, okay, this one is retail. Because retail, you the way you operate, including myself, I'm retail, right? The way I operate is actually like a hedge fund, Outside of hedge fund, I would say quite a majority of fund managers, their hands are tight one. So these questions, right? Wow, stock price down, I do leverage. No, usually, very, very rarely you see these kind of things, except for hedge funds, and except for those who manage on behalf of like family office or high net worth, that they really have the discretion to do whatever they like. I think these are small subset. The bigger subset, right, are those like, let's say, managing, let's say, sovereign wealth fund, managing insurance, managing pension, managing investment link, managing unit trust, ETF, these kind of things, usually they are all hands tight. Yeah, so I think that's something that I think my take on these questions now. Anyone want to like give comment on my on whatever I just shared? Next one. Oh, sorry, click the wrong one. What was your recent stock purchase or sell? Is it here or not? Okay, out on top of my head, I recently bought Amazon, Tesla, and ETF called the IUIT. I think the ETF, right, is the same one as the VGT, which is the IT MSCI information technology. So and the two largest companies are Apple and Microsoft in that ETF. I think they all added up is about 45%. So basically whatever that I'm buying is those in my portfolio already. I just add to the exposure. And the reason I bought into Amazon is also and also Tesla is also because the share price has corrected quite a fair bit. So it's a bit more like just rebalancing now. So add to the exposure that I already have. Yeah, I think that's a question for me, right? Do you think China stocks have capitulated? I think this is a good question. As I think, yeah, looking at the share price, you look at HSI index, right? I recall in the past about 25 years, right? Forget about dividend, right? Just look at the price index, right? I think 25 years go nowhere, like flat. So I think it's like, I mean, this kind of situation, you imagine 2047 and S&P 500 still haven't exceed 4,000. I mean, it's quite sad, right? When you have like such a long drag up and down, go back to the same place again, right? I think it's really, really, how to say, like hopeless kind of situations. So if you ask me whether it's already capitulated stage, looks likely. If just looking at the share price, I do agree there's this like sentiment that, okay, actually it's hopeless one. I do get the same feel. That's one thing. The second thing is I think for China stocks or Hong Kong or HSI, right? I think the headwinds is still there. I think I mentioned in one last week or the week before, which is that the like capital flight situation, and then the emperor now get more power. I mean, people surrounding him is all the, like the loyalists, right? So I think, I don't know, from governance perspective, I do think that there's a concern. And then their policy is also not really friendly to the businessman. That's the situations, right? It's just that the question is like, with current low valuations, is it cheap enough to offset this kind of like bad factors or bad factors, I would say. So I think this one depends. I still have quite a number of friends who are still very bullish, and they look at the Chinese stocks. They're so cheap, right? And then it's not like they don't have earnings, because if you look at Alibaba, their earnings is still okay, right? There's still earnings. So there are people who still think that this is a good chance to accumulate. And the counterpoints, which is like, the geopolitics, and then environment that may not be that friendly to the business. I think those type of concern, and also, like the real estate situations, right? I think all this together with zero COVID policy, I think the headwinds is still there. It's quite challenging environment for Chinese companies. I do think that those concerns are valid also. So the question is more like, okay, if we look forward 3 years, 5 years, do you think all these so-called concerns, right, like the geopolitics, the economics, the real estate downturn, zero COVID, do you think this will become like a past? If all this become a past, right, it means that we move on, like things recover, right? It's almost sure thing that the share price will go up, right? But we also don't know like whether these things will persist or not. So that's the concerns that I have. Yeah, I would say that I'm in the middle, somewhat on the bearish side. If I'm bullish, I already like keep on putting my money into all these stocks already. I'm still towards the bearish side, and I really have some concern. But if you ask me to short the stock market, I don't dare to do so. I prefer just to have some small exposure just to park it there. If it recover, then I'm happy, right? So, but if it continue to drop, then too bad, right? So that's my take now on this. Wow, how come the questions come up faster than what I can respond? What's your thought on retail favorites like Palantir and Sea Group? Wow, I think this one long story. I really need to get to those who are good with these two companies to comment. Good questions, but I don't think I can give a good like a comprehensive response, given that I haven't really paid too much attention to them since I sold Sea. I used to own Palantir. I remember when they just IPO, I bought, and then I sold like within short period of time now. So I think those who are in the Telegram group in the early days, right, they will know. So this one, yeah, I think we do a separate sessions on Palantir and Sea Limited. I think cover next time. Okay. Or who asked this question? Please PM me so that I can have a chat with you, see what questions that you want to ask in details, or what kind of comments that you want to give. Okay, but I know I have a couple of friends who pay attention to Palantir. Maybe I can try to interview them. Okay. Next one. Curious, we'll be using Zoom for future instead of Telegram video chat for future. Okay, let me explain a little bit. I think before I hit the record button, I also mentioned I paid for the Zoom. So I am the paid subscriber. If not, we cannot go past, like the 40 minutes, right? So I just want to try whether the quality is better or not. And indeed, I think it is better. That's why once I paid already, I think why not I just continue to use it, right? So let's say if you prefer Telegram, maybe you can drop me a message, tell me why you think Telegram is better. But I think Zoom, overall quality is better. That's why I think let's go for Zoom first, unless there's like serious concern on we should go back to Telegram. Yeah. So that's the thing. For me, it's just experiment and try out. Okay. Actually, I subscribe this not really for this weekend one. It's really meant for, sometimes I have some video interview with other friends, which I posted on my channel also, right? So it's really meant for that now. So I think just want to have a better platforms and physical meetup. I think sometimes it's good. It's just that when it comes to logistics, sometimes a bit hard. That need to go to different places, look for places to sit down and interview, right? So I think Telegram is no. I mean the Zoom interview sometimes could be a good platform for us to have this kind of sharing and then creating contents. So next one, how come you still buy Amazon, Tesla when stock price not bottom yet as shared? Wow. If I know stock price when it's going to bottom, right, then I might actually charge, like $100 or even $1,000 for discount insight, right? The thing is, I don't know when it's going to bottom. So that's why to me, it's like, I think I shared before, it's like my philosophy is that I like to study stocks. I like to buy into businesses. But I don't like to speculate on the timing. To me, timing is just too hard. Like it's very hard because to a certain extent, all these companies, their stock price, right, they have been reflected in the stock price. So say for example, like Amazon, right? If you look at their fundamentals, they are burning cash, they're not doing well, net income is like negative, right? So I think this kind of situation is bad. This is what I said in the past. If I know they have this kind of result, I also won't buy when the price was trading at, let's say 3,000 plus pre-split, right? So the situation is bad. That's I have to admit it. I like to invest in businesses, but I don't like to, play the timing. If I like to play the timing, you will see me keep on in and out, right? In fact, I try to minimize the impact of timing to my portfolio. So I have to really buy in slowly at different timing, right? So different, gradually buy in so that, if I buy in gradually, then I am not subject to the timing, right? So if really turned out to be a bad investment, I cannot blame I'm unlucky. I just bought at the unlucky, which is when the price is high, right? So it's not the case, right? So I just try to, take away the timing. That's why I need to buy in a gradual and consistent kind of deployments rather than just, looking at this chart pattern, I think capitulate already, this is the bottom. I don't have this kind of view. To me, it can always rebound and it can always get cheaper, right? That's why I buy small. If it becomes cheaper, then I buy more. Unless really the fundamentals really drop a lot more compared to the share price, then I stop buying. Or even I could sell, right? Yeah. So yeah, that's the comment on this question. Tesla, I'll say that Tesla actually in terms of their, I think Tesla, right? I think if you look at their numbers in Q3, I think it's really good. Yeah, it's really good result. So, and the prices came down. I think the price already kind of reflected a lower growth let's say in the next 1 year. That's why the price has came down. Because if you try to explain the share price drop by looking at Q3 numbers, you can't explain it because the Q3 numbers is looking at the past, and the Q3 number is quite good. So I think it's more like two things, right? One is that people price in a lower growth in the near future. And then secondly is because I think A also mentioned, right, now the interest rate is higher and then long-term yield has gone up. So when this happened, when you do your DCF, maybe it used to be enough if you just earn 10% from Tesla, right? But now you might want to increase it to 12% or 14%, right? Because the risk rate is a lot higher now. So I think the discounting is different now. So I think I will try to explain the recent share price drop by these two factors. Other than this, I think the performance is good, right? Yeah. Okay. What's your view on investing in REITs for retirement? Seems if we encounter times like this, when REITs prices drop, it will be quite bad situation. I think for REITs is like, I think, let me just explain again. I think I mentioned this in the past. When you invest in REITs, you're actually buying into holdings of real estates. It could be like retail, shopping malls or offices, right? These are the portfolios of assets that you own when you buy into REITs. The difference is between buying physical property versus buying REITs is that REITs, you have built-in leverage. This one, you need to check the balance sheet, look at how much debt that they are putting into the balance sheet. Number two is that you have managers that manage the holdings of real estates for you. So if you like the real estate exposure, I think REITs is a good way. The bad part is that when you invest in REITs versus you invest in stocks, right? It feels as if they are the same because their price fluctuating up and down by up and down. So the volatility is always there. But whereas, let's say if you buy a physical properties that you bought your own house, right? You don't check the price every day, right? So it gives us an impression that the value is stable. For REITs, right? Actually, their value is stable because all these shopping retail malls or offices, their value don't fluctuate on a daily basis. But because the REITs, right, they're packaged in like something like an ETF, so there's trading, hence there's daily volatility. So that's how you should look at REITs. The question number one is that whether you really want to get the exposure, meaning the real estate exposure. This is one. Number two, are you okay with the leverage? Because whenever the interest rate go up, right, the cost of financing is higher. That one will affect the REITs earnings in the future also. Number three is that you also need to have an outlook in terms of their rental. Do you think that the rental is on the uptrend, or is it like just stay stable, or is it you think that the rental yield will come down? So I think these are the main key factors. And number four, of course, if you invest in individual REITs, you want to look at their asset quality and determine whether those assets is the one that you want to own. So these are I think I mentioned like all the key one already. The details is always like when you look at specific REITs, what are the things to pay attention to? And then that one will vary, each individual REITs, they will be somewhat different. So back to these questions, I think the price drop, I do agree with A, he mentioned just now, right? It's because the let's say the SSB or the treasury bill is a lot higher now. If you ask me, if I just want to get a yield, I would rather just put into, let's say, SSB if the yield is comparable, right? So I think the SSB or the treasury bill or the REITs, right, they are actually invested by the same group of investors, right, who are actually aiming to get a yield, like they are yield investor or dividend investor, right? So they have to compete with each other. And when the treasury bill yield is higher, so that they won't form a competition, and hence it affects the REITs as well. So that's my interpretations. I think, of course, if you look at individual REITs, you might want to look at what's happened in the near, like in the recent past. Is there any concern with regards to their occupancy, with regards to their rental? Those are the things that if it happen, then it will have a big impact to the share price performance. Yeah, I think that's enough for comment from me. Given that REITs is not my focus in my investment right now. I don't have REITs now, so just for your information. Could you repeat what is the ETF you mentioned just now? You recently invest? Okay, this is the one, IUIT. So the ticker is IUIT. So this is S&P 500 Information Technology Sector ETF. So if you look at the holding, right, I think the holding Apple and Microsoft, these two added up is about 44%. And then the rest of the names, right, these are all considered under tech sector, but they are under various tech sectors. So you see there are names like Visa, MasterCard. These are payment, but I don't know why they are in the IT sector. And then you have some, like semiconductor, like NVIDIA, Broadcom, this Texas Instrument. These are semicon related. Then you have Salesforce, Accenture. And if you look at page 2, there are Adobe, Qualcomm, Oracle, Intel, Intuit, these kind of names. You can take a look at the websites. I think iShares, right, when it comes to their their disclosure, I think it's always the best one. And in fact, you can download, you see there's Excel file here. You can actually download this and look at the full listing. I think this is always useful whenever for those who invested in REITs. If you invest in iShares one, I mean, this is their format now. So I think this is good. For other things that is interesting. Why I bought into IUIT and not the VGT is because this is the island domicile one. They are listed in London Stock Exchange. So you need to check with your broker whether you can buy this. If not, it will be equivalent to VGT. VGT is Vanguard, but in terms of their benchmark or their index, they are exactly the same. So if you look at their past performance, I will say, past 3 years is still 14% average. So I think not too bad. But past 1 year, they dropped by 20%. I think this is very similar to QQQ. If you look at their correlations, right, it's very high one. I think it's a bit like, above 90% kind of correlation. It's just that for me personally, I have some, like I prefer, if you compare this versus the QQQ, I think QQQ, they have small, some biotech or some pharma exposure, which I don't really like. So I prefer this one more than the QQQ. But I also have some QQQ, which I bought some time ago. I just park it there, not doing anything. So I just do as little as I can. I don't want to keep on flipping my portfolio. Okay, then what about CSPX? I think CSPX, this is S&P 500. So this is like a more balanced one. So let's say if you are okay to own the entire sector, right? You want to own more financials, energy, then go for the CSPX. I think this is more balanced one. The IUIT is the one that focus on IT sector. When you have 44% into two companies, and those two companies are Apple and Microsoft, right? Both are, they are owning platforms, right? iOS and Windows, right? I mean, by looking at the main constituents, what kind of exposure that you are going to get, which is really tech exposure. So that's the IUIT. For CSPX, you get everything, right? You get, all the big cap in US. Hey, you subscribe to Zoom, you pay how much? What's the price already? I mean, you can look at the website. It's not that expensive. I think $10+ per month. That's the prices. Is their technology good and mean we can buy Zoom stock since stock dropped a lot? Let's try to explain why the price dropped, right? I think the price drop is because during the COVID, when we're entering COVID, everyone is using Zoom. Not everyone, but let's say like huge majority of people using Zoom, because Zoom, right, in terms of their product, is really the best as compared to the other alternatives like WebEx, even like Google Chat or whatever, right? So I think Zoom is the best as compared to the others in terms of their product. But the price went up too much because their growth during COVID period is super high. Like they basically just more than double in terms of their revenue and so on, right? So during that period, stock price also followed. And everyone say that, okay, this is not one-off thing. This become like a new normal. Nobody want to have physical meeting anymore. So Zoom become like a permanent thing. So that was the narrative, and hence the share price increased a lot, right? And if you look at the recent past, actually the growth actually come down a lot already, like really almost no growth if you compare to just 1 year ago. So when a stock, right, it is like value assuming that these things will be forever, and then suddenly now because of the growth, right, people keep on just extrapolating the growth and hence give a high valuations to the company. Now everything just reversed back, right? Hence the share price has dropped a lot now. So I would say that the share price dropped a lot mainly because of the growth. It's not that they are not making money. Actually, this company has been making money since before COVID. And after COVID, they earn even more money. It's just that if you hope for the kind of growth, right, that they are experiencing prior to during the COVID, right, I think this is a bit like not realistic because it seems that now, like people are like seeing COVID as something that's already passed, and then there are more and more physical events. I think in terms of their usage, right, in terms of their I think basically the usage, I think it will go down, and it might hurt their revenue also, right? So I think this is no longer a growth stocks, and the question is, given that it is not a growth stocks, their earnings might have some problem in the future. Are you fine to hold it or not? You might want to do some, look at their what's their valuation now and do some DCF and come to your own conclusions. Don't just look at how much the price has dropped. You need to understand when the price peak level, what's the kind of assumptions that has been built in. It could be that people are assuming that it is going to, double the revenue every years for another 3 years, right? If you have that kind of assumptions, of course now the growth is gone. Of course the share price will come down, right? So I think that's the situation with Zoom. Last question already. Free cash flow versus profit. It seems like free cash flow is skewed, especially for tech, because a lot of their salaries are share compensation. Share compensations. As such, it seems like profit is better gauge versus cash flow. I think this one depending on which company that you are talking about. I think for companies that they do give a lot of like stock-based compensations, right? Indeed, you might want to look at the profit, because if they are cash flow positive but their net profit is negative, it's because they didn't count the stock-based compensation into the cash flow, right? Their free cash flow looks good, right? What happened is that as an investor, you keep diluted one. So you want to account for that. That's a cost that is a real cost to the investor. So, but good thing is that the company, as long as they have free cash flow positive, right? They don't have to tap into the stock market and have that kind of like big dilution at the worst possible time. This kind of risk is much lesser as long as they have some positive free cash flow. But these stock-based compensations, right? They are not one-off things. They are like every year thing, right? So imagine that the companies, like they keep doing these stock-based compensations, right? And what another things that you might want to pay attention to is that those manager, the CEO, they get their shares, right? They'll just sell on the open markets. So after they sell, there's too much shares floating on the open market, so it depresses the price also, right? So you might want to pay attention to that. So I would say that given there's net profit and free cash flow, the number one I would look at, especially for this type of like newer companies, right? I think please be aware that net profit is the one that you should look at now. Okay, the free cash flow, because it's not comprehensive. That's why it might not be a good metrics. But let's say for companies that are already making money, okay, and there's a reason why their net income is always lesser than free cash flow for some reasons, right? Then free cash flow is something that you can look at because it reflects the cash in and out, right? So that is a better metrics for companies, mature companies. But for a lot of all these companies that I don't think is investable one, they will keep on saying that their key free cash flow is positive, but the SBC, a huge chunk in the SBC, they just ignore. I think those is really not a good practice. I think it's a bit misleading. So be careful on that. Okay, I think I have to stop now. Wow. I mean, thanks a lot for you all who submit the questions, and then at least this session we don't have the situation that we don't have questions and become like, oh, nothing to talk about, then we end, right? I do appreciate the questions, but I think if possible, right, maybe you can share the questions a little bit earlier, so that let's say if there's some preparation that I can do before the session, right? So I think that one is just to give me some time to prepare. I think this type of questions that come up some spontaneously, I think also good. But today, I think yesterday when I look at the questions, it's only like 2 or 3 questions, but suddenly I suddenly can't finish the questions. So yeah. But anyway, thanks a lot for the instruction. I think it always make the sessions fun. We will end the session here. Thanks a lot for everyone who joined. Appreciate all of you here. Thanks a lot. See you in the next one.